In today's video, we'll decode ICFR step by step, what it is, why it matters, how it's designed, implemented, tested, and reported, with practical ERP examples from SAP and Oracle, and common audit insights. By the end of this session, you'll have a complete understanding of how ICFR forms the backbone of trustworthy financial reporting. What is ICFR? Internal controls over financial reporting are the processes, policies, and activities implemented by management to provide reasonable assurance that a company's financial statements are accurate, complete, and comply with accounting standards like IFRS or US GAAP. These controls prevent and detect misstatements, whether caused by error, fraud, or system failures, in the company's books and records. ICFR ensures that every number reported, from revenue and expenses to assets and liabilities, is supported by valid, authorized, and verifiable transactions. In short, ICFR requires governance plus risk management plus control mechanisms, reliable financial reporting. Why ICFR matters. Financial statements are the heartbeat of any business. Investors decide, regulators assess, and stakeholders trust these reports. If those numbers are wrong, confidence collapses. A strong ICFR system ensures accuracy and reliability of financial data, prevents fraud and misrepresentation, enhances transparency and governance, builds investor and regulatory trust, reduces audit findings and compliance risks. In regulated environments like the United States, ICFR is not optional. Under the Sarbanes-Oxley Act, SOX, Section 404, management must annually assess and report the effectiveness of internal control over financial reporting. Auditors then independently test and provide their opinion on whether those controls are effective. Weak ICFR can lead to restatement of financial statements, material weakness disclosures, fines and regulatory penalties, loss of investor confidence, damage to brand reputation and market value. Framework behind ICFR, the COSO model. Most organizations use the COSO Framework, Committee of Sponsoring Organizations of the Treadway Commission, to design and assess ICFR. COSO defines 5 interrelated components and 17 principles that together create an integrated control environment. Let's break them down. 1. Control environment. This is the foundation, the tone at the top. It includes integrity, ethics, competence, management's philosophy, and governance structures. Are ethical values clearly communicated? Does management emphasize accountability? Are responsibilities and authorities well defined? A strong tone at the top drives a culture where controls are respected, not ignored. 2. Risk assessment. Here, management identifies and analyzes potential risks that could lead to material misstatement in financial reports. This includes both fraud risk and error risk. Example: incorrect revenue recognition, manual journal manipulation, or weak segregation of duties in the ERP system. Risk assessment determines which controls are necessary, how frequently they should operate, and who owns them. 3. Control activities. These are the actual policies, procedures, and mechanisms that mitigate identified risks. They include approvals, reconciliations, verifications, segregation of duties, and system-based controls. Control activities operate at both manual and automated levels. Examples: manual, manager review of reconciliations, sign-off of journal entries. Automated, 3-way match in SAP between purchase order, goods receipt, and supplier invoice. 4. Information and communication controls are only effective when accurate information flows to the right people at the right time. This component ensures systems capture, process, and deliver reliable data for decision-making and reporting. It also involves transparent communication channels for control owners, management, and auditors. 5. Monitoring activities. Monitoring ensures that controls are operating as intended. It includes self-assessments, continuous control monitoring tools, internal audit reviews, and management oversight. Regular monitoring helps detect deficiencies early and ensure timely remediation. Types of ICFR controls. Controls can be classified in many ways. Understanding their type helps auditors plan and test them effectively. Based on purpose, preventive controls stop misstatements before they occur. e.g., system access restrictions. Detective controls identify errors or fraud after occurrence, e.g., bank reconciliation. Corrective controls fix identified issues and prevent reoccurrence, e.g., re-performance with root cause analysis. Based on nature, manual controls, human performed, like review and approval of reports. Automated controls, system enforced, like validation checks or interface reconciliations. Hybrid controls, combination of manual oversight on automated processes. Based on entity-level controls, ELCs. Affect the organization as a whole, such as tone at the top, code of ethics, or oversight by the audit committee. Process-level controls, focused on specific processes, e.g., order to cash, procure to pay, payroll. Transaction-level controls, operate at the individual transaction level, validating details like quantity, price, or posting account. Financial statement assertions and control mapping. Each control links to a financial statement assertion, ensuring all material aspects of reporting are covered. Assertion meaning example. Control existence assets, liabilities, and equity interests exist. Physical verification of fixed assets. Completeness. All transactions that should be recorded are recorded. Sequential numbering of invoices and reconciliations. Rights and obligations. Entity holds or controls rights to assets. Legal documentation and contract reviews. Valuation and allocation assets and liabilities are recorded at appropriate values. Allowance for doubtful debts review. Presentation and disclosure transactions are properly classified and disclosed. Financial statement review checklist. Process examples. How ICFR works in real life. 1. Revenue, order to cash. Controls ensure revenue is recorded accurately, only for valid sales. System blocks revenue recognition before goods are shipped. SAP SD module. Credit limits are checked automatically before sales orders are confirmed. Near period end, review cutoff reports for premature revenue recognition. 2. Procurement to pay, P2P. Ensures payments are made only for valid purchases. Purchase orders require approval based on threshold hierarchy. Three-way match between PO, GRN, and invoice ensures authenticity. Vendor master data change requires dual approval. In Oracle ERP, automated workflows log all approvals for audit evidence. 3. Payroll. Ensures employee payments are authorized and accurate. HR authorizes new hires and terminations. Payroll system validates attendance and rates. Reconciliation of payroll expense with ledger and bank payments ensures completeness. 4. Financial close and reporting. Controls around journal entries and reporting processes. All manual journals must have supporting documentation. CFO reviews large or unusual journals. Trial balance is reconciled with subledgers before close. Financial reports are reviewed and approved before submission. Role of IT in ICFR, ITGC, and ITAC. Technology is deeply embedded in financial reporting. Hence, IT controls are an integral part of ICFR. IT general controls, ITGCs, access management. Only authorized users can access systems. Change management. System changes are tested and approved before implementation. Backup and recovery. Data integrity and availability are protected. Operations controls. Jobs and interfaces run as scheduled and are monitored. IT application controls, ITACs. Input controls. Validation of data entry fields, e.g., vendor code must exist. Processing controls. System automatically calculates taxes or discounts correctly. Output controls. Reports are generated and reviewed by authorized users. Interface controls. Data transfers between applications, SAP, GL, are reconciled automatically. Without strong ITGCs, even the best automated controls lose reliability. Auditors may have to treat them as manual and test differently. Testing ICFR. From design to operating effectiveness. Auditors test ICFR in two phases: design effectiveness and operating effectiveness. Design effectiveness. Testing. Ask, if this control operates as designed, will it prevent or detect a material misstatement? Includes walkthroughs, inspection of documentation, and control mapping. Operating effectiveness. Testing. Ask, is the control operating as intended consistently throughout the period? Techniques include inspection of evidence, e.g., signed reconciliations, observation of the process, re-performance, inquiry with corroboration, and sampling transactions across the period. Results are evaluated as deficiency, significant deficiency, or material weakness based on severity and impact. Common ICFR deficiencies. Unsegregated access. Same user can create and approve vendor payments. Late or missing reconciliations. Manual journal entries without review. IT access not revoked after employee termination. Unauthorized changes in accounting configuration. Lack of documentation or retained evidence. Each of these weaknesses can cause material misstatements or even fraud if left unaddressed. Remediation and continuous improvement. When control deficiencies are found, identify root cause, people, process, or system. Design a remediation plan with timeline and ownership. Implement the improved control and document evidence. Retest for effectiveness before sign-off. Continuous improvement can be achieved through automation, for example, robotic process automation for reconciliations, analytics for anomaly detection, and continuous control monitoring tools that flag exceptions in real time. Documentation. Auditor's evidence trail. Auditors expect to see updated RACM, risk and control matrix, process flowcharts and narratives, control testing sheets, evidence of performance, approvals, reports, screenshots, remediation logs and action trackers. Remember, if it's not documented, it didn't happen. The future of ICFR, automation and AI integration. Modern organizations are moving from manual testing to automated continuous monitoring. AI-driven tools now identify control exceptions, duplicate vendors, and unusual journal entries instantly. Auditors are adopting data analytics for full population testing instead of sampling. However, this evolution demands strong IT governance, change management, and audit trail transparency to maintain control reliability. Final takeaway. Internal controls over financial reporting are not just a compliance requirement. They are a reflection of organizational integrity, transparency, and governance maturity. Strong ICFR. Show trustworthy numbers. Weak ICFR. Financial risk, regulatory exposure, and damaged reputation. If you are an auditor, control owner, or compliance professional, your role in maintaining ICFR effectiveness is critical. Understand your process flows. Maintain segregation of duties. Test controls periodically. Document everything. Strengthen it and automated control reliance. This is Mayuri from Audit Decoded, bringing you simple, structured, and smart insights into auditing, cybersecurity, and compliance. See you in the next one. Until then, keep decoding, keep auditing.